If you think sitting on cash is the safest move right now, you might be losing money every single day, not in a way you can see, not in a way your bank shows you, but it's happening. If you want to understand where smart money is actually moving and how to protect your wealth in times like this, hit subscribe right now, because what's coming next will change the way you think about money. Inflation quietly eroding the real value of cash is one of the most overlooked financial risks because it does not appear as a direct loss on a bank statement. The number in an account may remain the same or even grow slightly due to interest, but what that money can actually buy decreases over time. As prices for everyday goods and services rise, each dollar holds less purchasing power than before. This means that even without spending, an individual is effectively losing wealth in real terms. The challenge is that inflation often moves gradually, making its impact less noticeable in the short term, but significantly damaging over longer periods. When inflation rates exceed the interest earned on savings, the gap represents a guaranteed loss in real value. Central banks like the Federal Reserve aim to manage inflation, but even moderate levels can compound over time and reduce the effectiveness of holding large amounts of idle cash. This dynamic becomes more pronounced during periods of elevated inflation, where price increases outpace wage growth and savings returns simultaneously. Many people underestimate how quickly this erosion can accumulate, especially when combined with rising costs in essential areas such as housing, healthcare, and food. The result is a silent transfer of value away from cash holders, where money that appears stable is actually declining in real economic strength, gradually reducing financial security and limiting future purchasing ability. The opportunity cost of missing market gains is one of the most significant hidden drawbacks of holding large amounts of cash, especially during periods when assets are appreciating. Opportunity cost refers to the potential returns an individual gives up by not investing in assets that could generate growth over time. While cash provides liquidity and a sense of security, it does not typically produce returns that can compete with equities, real estate, or other investment vehicles over the long term. When markets rise, whether driven by earnings growth, innovation, or investor sentiment, those who remain on the sidelines miss out on compounding gains that can significantly increase wealth. Even short periods of market participation can have a meaningful impact, as some of the strongest gains often occur in brief, unpredictable windows. Trying to time the market by staying in cash and waiting for the perfect entry point can result in missed opportunities, as markets may continue to move higher despite uncertainty. Over time, this hesitation can lead to a widening gap between those who are invested and those who are not. Additionally, reinvesting returns allows for compounding, where gains generate further gains, accelerating wealth accumulation. By contrast, cash remains static, unable to benefit from this effect. While avoiding short-term volatility may feel like a safer strategy, it often comes at the cost of long-term growth, making the decision to stay fully in cash more expensive than it initially appears. The relationship between interest rates and real returns plays a critical role in determining whether holding cash actually preserves wealth. While higher interest rates may give the impression that cash is finally earning something, the key factor is how those returns compare to inflation. Real return is calculated by subtracting inflation from the nominal interest rate, and if inflation remains equal to or higher than the return on savings, the result is effectively zero or negative in real terms. This means that even though a savings account or money market fund may show growth, the purchasing power of that money is not increasing and may still be declining. Policies set by institutions like the Federal Reserve influence short-term interest rates, but they do not guarantee that savers will achieve positive real returns, especially in periods of persistent inflation. Another factor is taxation, which can further reduce the effective return on interest income, widening the gap between nominal gains and real purchasing power. Additionally, rates can fluctuate over time, and what appears attractive in the short term may not be sustainable as economic conditions change. Many individuals focus on the visible yield of cash instruments without considering the broader economic context, leading to a misunderstanding of actual returns. The result is a situation where cash appears to be working, but in reality, it may only be slowing the pace of loss rather than generating meaningful growth in wealth. Asset appreciation outpacing idle money highlights the growing gap between invested capital and cash that remains on the sidelines. When assets such as stocks, real estate, or commodities increase in value over time, they benefit from factors like earnings growth, demand-supply imbalances, and long-term economic expansion. Cash, by contrast, does not participate in these growth drivers. It remains static, meaning its relative value declines as other assets move higher. This dynamic becomes more pronounced during periods of strong market performance, where gains in asset prices can significantly outpace the modest returns generated by savings accounts or short-term instruments. Even in environments with higher interest rates influenced by institutions like the Federal Reserve, the appreciation of productive assets often exceeds the yield on cash over longer time horizons. Real estate values may rise due to limited supply and population growth, while equities can benefit from innovation, productivity improvements, and expanding corporate profits. As these assets grow, they create wealth for investors through both price appreciation and, in some cases, income generation, such as dividends or rental yields. Meanwhile, individuals holding cash miss out on these gains, leading to a widening disparity in wealth accumulation over time. This divergence can become substantial, especially when compounded over years, as invested assets continue to build on previous gains while idle money fails to keep pace with the broader expansion of the economy. Currency debasement refers to the gradual decline in a currency's purchasing power over time, often driven by an expansion in the money supply. When more money is created within an economy without a proportional increase in goods and services, each unit of currency represents a smaller share of overall value. This process can occur through policies implemented by central banks like the Federal Reserve, especially during periods of economic stress when liquidity is injected to stabilize financial systems. While such measures can support short-term growth and prevent deeper crises, they also contribute to long-term pressure on the currency's real value. For individuals holding large amounts of cash, this creates a silent erosion, as the same amount of money buys less over time. Unlike market volatility, which is visible and immediate, currency debasement is gradual and often goes unnoticed until its effects become significant. It can influence a wide range of costs, from everyday expenses to long-term investments, reducing the effectiveness of cash as a store of value. Additionally, global factors such as trade imbalances, geopolitical shifts, and changes in reserve currency dynamics can further impact the strength of a currency. As confidence in a currency weakens, it can lead to higher inflation expectations and shifts in investment behavior. The result is a long-term environment where holding cash without strategic allocation exposes individuals to a steady decline in real wealth, driven not by sudden events but by ongoing monetary expansion and structural economic forces. Overconfidence in the perceived safety of cash is a common behavioral bias that can lead to unintended financial consequences, particularly during uncertain economic periods. Cash is often seen as risk-free because its nominal value does not fluctuate like stocks or other assets, creating a sense of stability and control. However, this perception can be misleading because it focuses only on visible volatility while ignoring hidden risks such as inflation, currency debasement, and lost opportunity. When individuals prioritize emotional comfort over strategic decision-making, they may allocate too much of their portfolio to cash, believing they are avoiding risk altogether. In reality, they are simply exchanging one type of risk for another, one that is slower, less visible, but equally impactful over time. This mindset is reinforced during periods of market uncertainty when fear drives people to retreat into cash positions rather than assess long-term fundamentals. Policies and signals from institutions like the Federal Reserve can further influence this behavior, as changes in interest rates may temporarily make cash appear more attractive without fully offsetting underlying risks. Additionally, the absence of short-term losses can create a false sense of success, even as purchasing power declines in the background. This disconnect between perception and reality leads to decisions that feel safe but may ultimately hinder wealth preservation and growth, especially when maintained over extended periods. Strategic allocation versus emotional decisions plays a central role in how individuals manage cash and investments, especially during uncertain economic conditions. Strategic allocation involves deliberately distributing capital across different asset classes based on long-term goals, risk tolerance, and market conditions. It is guided by planning, discipline, and a clear understanding of how different assets behave over time. In contrast, emotional decisions are often driven by fear, uncertainty, or short-term market movements, leading individuals to hold excessive cash simply because it feels safe. This reaction can become particularly strong during periods of volatility, when headlines and market swings create anxiety and push people toward inaction. However, relying too heavily on emotion can result in missed opportunities and an unbalanced portfolio that fails to grow effectively. Strategic allocation does not mean avoiding cash entirely. It means using it with purpose, such as maintaining liquidity for emergencies or positioning for future investments, rather than treating it as a default holding. External factors, including monetary policy decisions from institutions like the Federal Reserve, can influence market conditions, but they should not dictate reactive behavior without careful analysis. A disciplined approach allows investors to remain focused on long-term outcomes, adjusting allocations as needed without abandoning their overall strategy. By contrast, emotional decision-making often leads to inconsistency, where individuals move in and out of cash at the wrong times, ultimately reducing their ability to build and preserve wealth over time. Long-term wealth erosion from inaction occurs when individuals remain overly passive with their financial resources, allowing time and economic forces to diminish the real value of their money. While inactivity may feel like a safe or neutral choice, it often leads to missed growth opportunities and a gradual decline in purchasing power. Over extended periods, factors such as inflation, currency debasement, and rising living costs continuously reduce the effectiveness of idle cash. Without exposure to assets that have the potential to grow or generate income, wealth does not keep pace with the broader expansion of the economy. This creates a widening gap between those who actively allocate capital and those who remain on the sidelines. Compounding plays a crucial role in this process, as even modest returns can build significantly over time when reinvested, whereas cash does not benefit from this effect in a meaningful way. Policies influenced by institutions like the Federal Reserve can shape economic conditions, but they do not eliminate the long-term impact of inaction. Another issue is that delaying decisions in pursuit of perfect timing often results in prolonged periods of inactivity during which opportunities pass by. This hesitation can become costly as the cumulative effect of small, consistent losses in real value adds up over years. The absence of visible losses can make this erosion difficult to recognize, but its impact becomes clear over time as financial goals become harder to achieve and the true cost of staying inactive is gradually revealed. The real danger of sitting on cash isn't that it feels risky, it's that it feels safe. Every day, inflation quietly reduces its purchasing power, interest barely keeps pace, and opportunities for growth pass by unnoticed. Holding cash may seem like a protective strategy, but over time it allows invisible losses to accumulate while invested assets continue to grow. Overconfidence in safety, emotional decision-making, and delayed action only magnify the problem. Strategic allocation, awareness of opportunity cost, and understanding the forces eroding wealth are the tools needed to protect and grow capital. The lesson is clear. Inaction is not neutral. It is a slow drain on your financial future. Those who recognize this, who act thoughtfully and strategically, are the ones who preserve and build wealth in a world where cash alone cannot protect them. Sitting still may feel comfortable today, but over the long term it is far more dangerous than most people realize.